Venture capital funds are the Olympians of equity investing. Also called VCs, these are professionally managed investment organizations that take a focused approach to selecting, nurturing, and exiting from high-impact firms. Traditionally, VCs fund projects that have customers, are scalable, create new markets, and are managed by a passionate and professional team. VC's value expands beyond capital invested and includes a huge network, experience, and strategic advice. In some cases, VCs help find a CEO that is better prepared to lead a company's exponential growth. That was the case of Google, for example. VC funds expect to be part of the organization for 3 to 7 years and make a very large return on their investments. This type of investments create fascinating success stories. The first one being the investment in DEC, Digital Equipment Corporation, by the first VC fund, ARDC, in Boston. This investment provided a return of over 500 times the capital invested, an annualized 101%, from 1957 to 1968. Unheard of. More recently, Google provided an estimated 344 times gain to the Sequoia VC fund. Facebook also provided an amazing return, but their share price dropped after it went public, so it is hard to make the calculations. There are, however, very few extremely successful investments like this case, and hardly ever we hear about their failures. Most people are unaware of a few important facts about VC funding. First and foremost is that a large portion or all of the funds of the VC do not belong to the general partners who are making the investment decisions. Next, the cost of supporting each investment is large, and therefore, VCs usually fund companies that need above $1 million. In addition, VC funds have a limited lifespan and must close the fund after a set number of years, usually 10. Afterward, the managers might open another fund. Because of these facts, time is especially important in VC funding. Lastly, VC funds traditionally invest in league with others and invest in series of share tranches, like Series A, B, C, and so forth. This allows new investors to join at a different valuation, usually higher. This also helps reduce the investment risk by tying the valuation of shares to specific milestones or accomplishments. From all of the equity investment options, VC funds are the easiest to research. So do your homework and evaluate whether there is a good fit between your project and a specific fund. You might want to check whether your project fits their criteria and whether they have invested in a company that competes with yours or can be supplier, clients, or partners of your company. If a VC fund has invested in a company that works in your industry, it might be easier for them to evaluate your firm. Make sure you are very, very well prepared to talk to VCs. In Silicon Valley, angels are very valuable when dealing with VCs, especially if this is your first time. In other regions, I have found that VCs are less interested in angels-backed ventures. VCs are likely to help you capture a great opportunity by strengthening your team. That might include removing you from the leading position in your project.